Hello everyone, this is Mehdi Kari, the tax auditor of the Large Taxpayers Unit and the instructor on tax studies. Very welcome to this comprehensive lecture on the taxation of foreign companies in Iran, created by Tax Trainer Academy.
Tax Trainer by Mehdi Kari.
Today, we will explore one of the most important topics in Iranian tax law, the taxation framework applicable to foreign legal entities and non-resident companies that derive income from Iranian sources. Our discussion will focus on several key provisions of the Iranian Direct Taxation Act, including Article 105, 107, 113, 190, 191, and Article 192. In addition, we will examine the executive bylaw of Article 107, which plays a critical role in determining the taxable income of foreign enterprise engaged in activities connected with Iran. This topic is particularly relevant for multinational corporations, international contractors, engineering and consulting firms, foreign investors, tax professionals, accountants, lawyers, and compliance specialists. As globalization continues to increase cross-border business activities, foreign companies frequently enter the Iranian market through engineering contracts, construction projects, technical assistance agreements, software licensing agreements, training services, and technology transfer contracts. However, this engagement has unfortunately decreased because of the sanctions for several years. Anyway, whenever income is generated from Iranian sources, tax implications arise. Therefore, understanding the applicable tax rules is essential for ensuring legal compliance, minimizing tax risk, and avoiding penalties. By the end of this lecture, you will understand how foreign companies are taxed in Iran, how taxable income is calculated, what withholding tax obligation exists, how penalties are imposed, and under what circumstances penalties may be reduced or forgiven. Let's begin by examining the overall structure of corporate taxation in Iran.
Tax Trainer by Mehdi Karimi.
Part 1, General Framework of Corporate Taxation in Iran. To understand the taxation of foreign company, we must first understand the broader structure of corporate taxation under Iranian law. Generally speaking, legal entities may be classified into two categories. One, resident legal entities, and two, non-resident of foreign or foreign legal entities. Resident companies are generally taxed on their taxable profit according to the provisions of the Direct Taxation Act. Foreign companies, however, are primarily taxed on income derived from Iranian sources. This reflects what tax scholars call the source principle of taxation. Under this principle, the country has the right to tax income generated within its economic territories, regardless of the taxpayer's countries of residence. Therefore, when a foreign company earns revenue through activities connected to Iran, Iranian tax jurisdiction may arise. The principal legal foundation for corporate taxation is Article 105 of the Direct Tax Act. Part 2, Article 105, Taxation of Legal Entities. Article 105 is one of the cornerstone provisions of Iranian corporate taxation. According to this article, the aggregate income earned by legal entities through profit-making activities is subject to corporate income tax after deducting allowable expenses, recognized losses, and finally applicable exemptions. The standard corporate income tax rate established under Article 105 is 25%. This rate applies to taxable income rather than gross revenue. In practical terms, taxable income is generally calculated as follows. Taxable income is equal to gross revenue minus allowable expenses minus deductible losses and finally minus legal exemptions. The purpose of Article 105 is to ensure that companies contribute the portion of their economic gains to public revenue while maintaining the fair and predictable taxation system Also, Article 105 primarily governs Iranian companies. It is also relevant for foreign entities under certain circumstances. For example, a foreign company may establish a branch office or representative office or operational presence within Iran. If such an entity maintains accounting records and conduct activities that generate taxable profit, Article 105 may become directly relevant in determining the applicable tax burden. Let's check a practical example. Consider a foreign engineering company establish a branch office in Tehran. During a fiscal year, the branch generates gross revenue of $10 million and incurs allowable expenses totaling $4 million. Its taxable income would therefore equal $6 million. Applying the corporate tax rate of 25% would result in corporate income tax liability of $1.5 million. This example demonstrates the basic mechanism of operates taxation under the Article 105. However, foreign companies frequently operate under special rules that differ from the ordinary corporate taxation. These special rules are primarily contained in Article 107.
Tax Trainer by Mehdi Karimi.
Part 3, Article 107, Taxation of Foreign Companies. Article 107 is the most important provision governing the taxation of foreign legal entities in Iran. The article establishes specific framework for taxing foreign companies that derive income from Iranian sources without necessarily maintaining a permanent corporate structure in Iran. The rationale behind Article 107 is straightforward. Tax authorities often face significant challenges when attempting to audit the accounting records of foreign companies located outside Iran. As a result, the legislature created a simplified system for determining taxable income rather than relying exclusively on audited accounting profits. The law authorizes use the profitability coefficients and estimate taxable income ratios. These coefficients are specified in the executive bylaw of Article 107. Article 107 applies to a wide range of commercial activities, including engineering services, technical consulting, project supervision, design services, technical calculations, technology transfer, educational and training services, licensing agreements, royalty agreements, and finally the transfer of industrial know-how. The article is particularly important in industries such as oil and gas, petrochemicals, infrastructure development, telecommunications, information technology, and industrial manufacturing. Taxable income determination. One of the defining characteristics of Article 107 is the taxable income may be determined using predetermined profitability coefficients rather than actual accounting profits. Under the executive bylaw, the specified percentage of gross receipts may be treated as taxable income. The applicable percentage varies depending on the nature of the activity, and in many cases, coefficients ranging from approximately 10% to 40% may be used. Once taxable income is determined through the applicable coefficients, the relevant corporate tax rate is applied. This method significantly simplifies tax administration and reduces disputes concerning foreign accounting standards and financial reporting systems. I want to provide you with an example to make it more clarified. Suppose a foreign consulting company enters into a contract with an Iranian industrial enterprise. The contract value is 5 million euros. Assume that the applicable profitability coefficient under the executive bylaws is 20%. Under this approach, the taxable income is 25% multiplied by 5 million euros, that equal to 1 million euros. By applying the corporate tax rate of 25%, we have the tax liability of 225,000 euros. Part 4, Article 107, Advanced Analysis, Withholding Obligations, and Practical Applications. In the previous section, we discussed the basic framework of Article 107 and the concept of determining taxable income through profitability coefficients. Now, let us examine the practical implementation of Article 107 in greater details. Categories of income subject to Article 107. One of the most important aspects of Article 107 is understanding which types of income fall within its scope. Generally, the article applies to income derived from technical and engineering services. These services may include engineering design, project management, technical supervision, feasibility studies, industrial consulting, environmental assessment, quality control services, and engineering calculations. For example, a foreign engineering company engaged in design a refinery expansion project may become subject of the Article 107. Technology transfer agreements. Modern business transactions frequently involve the transfer of technical knowledge rather than physical goods. Examples include industrial know-how, proprietary manufacturing methods, operational procedures, software technology, technical documentation, and specialized production system. When compensation is received for the transfer of such knowledge, the result income may be taxable based on Article number 107. Training and educational services. Many international corporations provide specialized training programs to Iranian personnel. These programs may involve industrial training, management training, software training, uh, technical certification programs, and operational workshops. Payments received for such services may fall within the scope of Article 107. Royalties and licensing agreements. Royalty income is another major category covered by the article. A royalty generally represents payment for the right to use patents, trademarks, softwares, copyrights, technical information, or proprietary technologies. For instance, if an Iranian manufacturer pays a foreign corporation for the right to use a patent production process, the result in royalty income may be subject to taxation under Article number 107. Withholding tax mechanism. One of the most significant compliance features of Article 107 is the withholding mechanism. A withholding tax system shifts part of the tax collection responsibility from the foreign company to the Iranian payer. Under this framework, the Iranian company making the payment may be required to first calculate the applicable tax, second, deduct the tax from the payment, and third, remit the tax to the Iranian tax administration, and finally, transfer the remaining balance to the foreign recipient. This mechanism significantly improved tax collection efficiency rather than attempting to pursue taxpayers located abroad. The government collect tax directly through domestic payers, and as a result, withholding tax serves as an important risk management tool for tax authorities. Joint liability risks. An often overlooked aspect of Article 107 is the concept of joint liability. Many companies mistakenly assume that tax obligations belong exclusively to the foreign contractor. In reality, the Iranian payer may also face legal responsibility if withholding obligations are ignored. This means that failure to properly withhold and remit taxes can expose the Iranian company to additional tax assessment, financial penalties, late payment charges, and administrative disputes. Consequently, contract managers, finance departments, and legal terms must carefully evaluate withholding obligations before making international payments. Practical example: engineering contract. Let's consider a practical case. A French engineering company enters into a contract with an Iranian petrochemical enterprise. The total contract value is 12 million euros. The foreign company is responsible for technical design, project supervision, engineering calculations, and implementation support. Assume that the applicable profitability coefficient under the executive bylaw is 25%. So, The calculation would proceed as follows. Gross revenue is equal to 12 million euros. So taxable income is equal to 25% multiplied by 12 million euros is equal to 3 million euros. So by applying the corporate tax rate, we have the tax liability of 750,000 euros. Accordingly, the Iranian payer may be required to withhold and remit 750,000 euros before transferring the remaining contract amount. So let's examine another example, software licensing agreement. Consider another scenario. A foreign software developer grants an Iranian industrial company a license to use specialized production management software. The licensing fee equals $3 million. Assume the applicable coefficient is 30%. So the taxable income would be 30% multiplied by $3 million and equal to $900,000. By applying the corporate tax rate, we have the tax liability of $225,000. Therefore, a tax obligation of 225,000 dollars, may arise under Article 107.
Tax Trainer by Mehdi Karimi.
Documentation requirements. One of the most effective ways to reduce tax disputes is maintaining comprehensive documentation. Foreign companies should preserve signed contracts, amendments and addenda, invoices, technical reports, correspondence, payment confirmations, delivery records, and finally, project completion certificates. Tax authorities frequently rely on documentary evidence when determining the nature of a transaction. Poor documentation may lead to reclassification of income and increased tax exposure. Contract structuring consideration. Tax consequences can vary significantly depending on how a contract is structured. For example, a contract may include several components, including equipment supply, installation services, technical assistance, training services, and license and rights. Each component may be treated differently for tax purposes. Therefore, proper contract drafting is not merely a legal exercise, it is also a tax management strategy. Experienced international tax advisors often recommend clearly separating various contract elements in order to improve transparency and reduce compliance risks. Common compliance mistakes. In practice, foreign companies frequently encounter tax difficulties due to avoidable errors. Some of the most common mistakes include failure to understand withholding obligations. Many foreign contractors assume that tax compliance is entirely the responsibility of the Iranian customer. This assumption may lead to unexpected tax assessments. The second is inadequate documentation. Insufficient records often create disputes regarding the nature and value of services provided. The third one is improper contract classification. Misclassifying royalty as service income or vice versa may result in incorrect tax calculations. And finally, is failure to seek professional advice. International tax transactions frequently involve complex legal and administrative requirements. Professional guidance can significantly reduce compliance risks. Strategic importance of Article 107. From a broader perspective, Article 107 plays a critical role in Iran's international taxation framework. The article ensures that foreign enterprises contributing to economic activity in Iran participate in the country's tax system. At the same time, it provides the practical mechanism for determining taxable income without requiring extensive audit of foreign accounting records. For multinational corporations, understanding Article 107 is essential because it directly affects project profitability, contract pricing, cash flow management, withholding tax exposure, compliance obligations, and overall investment planning. Consequently, Article 107 should be considered during the early stage of contract negotiations rather than after transaction has already been executed.
Tax Trainer by Mehdi Karimi.
While Article 107 establishes the legal foundation, the practical application of the article depends heavily on its executive bylaw. The executive bylaw specifies the categories of activities, the applicable profitability coefficients, and the procedures used by tax authorities to determine the tax income. Therefore, in the next session, we will examine the executive bylaw of Article 107 and its practical significance for foreign companies operating in or earning income from Iran. So, we have come to the end of today's session. Thank you for your attention. I wish you success in your professional and academic endeavors. Goodbye and see you in the next lecture.